Derivatives are financial contracts whose value comes from something else like a stock price, an interest rate, or a commodity price. Think of a derivative as a ticket that lets you bet on the future movement of the underlying asset without actually owning it. Market mechanics. Primary market, dealers create new contracts and sell them to investors. Secondary market, investors trade existing contracts among themselves. Clearinghouse acts like a guarantor, making sure both sides honor the contract. It also nets out positions so each participant only posts a small margin. Margin similar to a security deposit. It protects the system from large losses. Real-world analogy: buying a concert ticket, the derivative, gives you the right to attend the concert, the underlying event, but you don't own the venue. If the concert is cancelled, the ticket becomes worthless, just like a derivative that expires out of the money. Options are the most common type of derivative and come in two basic flavors: calls, right to buy, and puts, right to sell. Classification. American versus European. American can be exercised anytime before expiration, European only at expiration. Vanilla versus exotic. Vanilla are standard calls and puts. Exotic have more complex payoff, for example barrier Asian digital. Payoff diagrams help visualize risk over reward. Long call payoff equals the maximum of S sub t minus k and 0. You profit when the price S sub t at maturity is above strike k, loss limited to premium paid. Long put payoff equals the maximum of k minus S sub t and 0. Profit when price falls below k. Short call or put, opposite payoff. Seller receives premium but faces unlimited call risk or large put risk. Analogy: a call option is like renting a purchase option on a car. You pay a small fee premium for the right to buy the car at a fixed price strike later. If the market price of the car rises above that price, you exercise and gain. If it stays lower, you let the option expire and only lose the fee. The Black-Scholes model gives a closed-form price for a European call, and by parity a put on a non-dividend paying stock. Formula: call price, C equals S0 times N of D1 minus K times E to the minus RT times N of D2. Put price, P equals K times E to the minus RT times N of negative D2 minus S0 times N of negative D1. Where D1 equals the natural log of S0 divided by K plus the sum of R plus sigma squared over 2 times T, all divided by sigma times the square root of T D2 equals D1 minus sigma times the square root of T n of a variable, is the cumulative normal distribution function. Numerical example. Assume current stock price S0 equals $100, strike K equals $105, time to maturity T equals 0.5 years, that is 6 months, risk-free rate R equals 5% per annum continuous, volatility sigma equals 30% per annum. Step 1. Compute D1. The natural log of 100 divided by 105 equals the natural log of 0.95238, which equals negative 0.04879. R plus sigma squared over 2 times T equals 0.05 plus 0.09 divided by 2 times 0.5, which equals 0.05 plus 0.045 times 0.5, giving 0.095 times 0.5 equals 0.0475. The numerator equals negative 0.04879 plus 0.0475, which equals negative 0.00129. The denominator equals sigma times the square root of t, which is 0.3 times the square root of 0.5, equal to 0.3 times 0.7071, giving 0.2121. Thus D1 equals negative 0.00129 divided by 0.2121, approximately negative 0.0061. Step 2. D2 equals D1 minus sigma times the square root of t, which is negative 0.0061 minus 0.2121, giving negative 0.2182. Step 3. Look up N of D1 approximately 0.4976, N of D2 approximately 0.4136. Step 4. Call price C equals 100 times 0.4976 minus 105 times e to the minus 0.0, 5 times 0.5 times 0.4136. The discount factor e to the minus 0.025 is approximately 0.9753. Thus C equals 49.76 minus 105 times 0.9753 times 0.4136, which equals 49.76 minus 42.34, giving $7.42. Thus the fair price of the 6-month European call is about $7.4. Using the same steps, the put price via put call parity is P equals C plus K times e to the minus RT minus S0. Approximately 7.42 plus 105 times 0.9753 minus 100, which equals $8.23. A futures contract is an agreement to buy or sell an asset at a predetermined price on a future date. Unlike forwards, futures are standardized, exchange-traded, and marked to market daily. The theoretical futures price F0 is derived from the cost of carry model. F0 equals S0 times e to the power of open parenthesis R plus U minus Y close parenthesis times T. S0 equals spot price. R equals risk-free rate. U equals storage cost as a continuous rate. Y equals convenience yield, the benefit of holding the physical. T equals time to maturity in years. Each day the exchange settles the profit or loss based on the change in the futures price. The daily settlement acts like a cash flow that keeps the contract's value near zero for both parties. Assume spot price of crude oil S0 equals $70 per barrel. Risk-free rate R equals 3% per annum continuous. Storage cost U equals 1% per annum. Convenience yield Y equals 0.5% per annum. Time to delivery T equals 0.25 years or 3 months. F0 equals 70 times e to the power of open parenthesis 0.03 plus 0.01 minus 0.005 close parenthesis times 0.25, which equals 70 times e to the power of 0.00875, approximately 70 times 1.00879, which equals $70.62. So the 3-month crude oil futures price should be about $70.62. If the market price deviates, arbitrageurs will buy the cheap side and sell the expensive side, forcing convergence. On day 1, the futures price is $70.62. At the end of day 2, it rises to $71. The long position receives open parenthesis 71 minus 70.62 close parenthesis times contract size, for example 1,000 barrels, which equals $380 cash. The short pays $380. This daily cash flow keeps the exposure limited to the margin posted. Explanation: an interest rate swap is a contract where two parties exchange streams of cash flows, usually a fixed rate leg for a floating rate leg, based on a notional principle that never changes hands. Party A pays fixed percent on N every 6 months, receives floating LIBOR, or SOFR on N. Payments are netted. If floating is greater than fixed, the floating payer pays the difference, and vice versa. Valuation: the value of the swap is the present value, PV, of the difference between the fixed leg and the floating leg. At initiation, the swap is set so that PV equals 0, meaning the fixed rate, swap rate, equals the market's expectation of future floating rates. PV fixed equals N times the sum from I equals 1 to N of alpha I times K times DF of TI. PV float equals N times open parenthesis 1 minus DF of T, N close parenthesis. Where alpha I equals accrual factor, for example 0.5 for semi-annual, K equals fixed rate, DF of TI equals discount factor to payment date TI, the floating leg PV simplifies to the difference between the notional and the last discount factor, because the floating rate resets to the market rate each period. Swap curve construction: use market instruments, for example OIS rates, LIBOR futures, IRS to bootstrap discount factors and forward rates step by step. Step 1. Obtain OIS discount factors for short maturities. Step 2. Use an IRS quote, for example 2-year 3-month LIBOR swap rate, and the already known discount factors to solve for the 6-month forward LIBOR rate. Step 3. Continue iteratively to build a curve of forward rates for each period. This curve is called the swap curve and is used to price swaps and interest rate derivatives. Illustrative example: notional N equals $10 million. Tenor equals 2-year semi-annual payments, N equals 4. Market 2-year swap rate K equals 2.5% annual paid semi-annually. which is 1.25% each period. Discount factors from OIS for 0.5, 1.0, 1.5, 2.0 years. DF 0.5 equals 0.987, DF 1.0 equals 0.974, DF 1.5 equals 0.961, DF 2.0 equals 0.948. PV fixed equals 10 million times open bracket 0.5 times 0.0, 125 times 0.98, 7 plus 0.5 times 0.0. 125 times 0.974 plus 0.5 times 0.0, 125 times 0.96, 1 plus 0.5 times 0.0, 125 times 0.948 close bracket equals 10 million times 0.00625. Times open parenthesis 0.987 plus 0.974 plus 0.961 plus 0.948 close parenthesis equals 62,500 times 3.870. Approximately $241,875. PV float equals 10 million times open parenthesis 1 minus DF 2.0 close parenthesis equals 10 million times open parenthesis 1 minus 0.948 close parenthesis equals $520,000. Swap value to fixed payer equals PV float minus PV fixed equals 520,000 minus 241,875 equals $278,125. Since at initiation the swap rate would be set so this value is 0, the market rate of 2.5% is the fair fixed rate for these discount factors. Explanation: two related contracts are forward rate agreements, FRAs, and currency swaps. Both allow parties to lock in future rates, but they differ in purpose and structure. Forward rate agreement. An FRA is an over-the-counter contract where two parties agree on the interest rate for a future period on a notional amount. At the start date, no cash moves. At the settlement date, they exchange the difference between the agreed-upon rate, the FRA rate, and the prevailing market rate, for example LIBOR, discounted to present value. Formula for FRA payoff to the buyer who receives the fixed rate. Payoff equals N times R market minus RFRA times delta times DF settlement, where delta equals day count fraction of the underlying period. Currency swap. A cross-currency swap exchanges principal and interest payments in two different currencies. Typically, each leg consists of a fixed or floating rate on its own currency. At initiation, the notional amounts are exchanged at the spot foreign exchange rate. At maturity, the principals are re-exchanged at the same spot rate, eliminating foreign exchange risk. Comparative analysis. Purpose. Forward rate agreement locks in a single currency interest rate. Currency swap manages both interest rate risk and foreign exchange risk. Cash flow timing. Forward rate agreement has a single net settlement. Currency swap has multiple periodic payments and two principal exchanges. Pricing. Both rely on discount curves, but a currency swap requires two curves, one per currency, and a cross-currency basis spread. Calculation example, FRA. Assume notional N equals $5 million. FRA rate equals 2.0% for a 3-month period starting in 6 months. That is a 6 by 9 FRA expected LIBOR 6-month rate at start equals 2.4%. Day count delta equals 0.25 for 3 months. Discount factor to settlement for 6 months equals e to the minus 0.015 times 0.5, approximately 0.9925. Payoff equals 5 million times open parent 0.02. 4 minus 0.020 close parent times 0.25 times 0.9925 equals 5 million times 0.004 times 0.25 times 0.9925 equals 5 million times 0.009925, approximately $4,962.5. The buyer, the receiver of fixed, receives about $4,963 at settlement. Calculation example, currency swap. Two firms, US Corp in US dollars and EU Corp in euros, agree to swap $10 million for 9 million euros with spot foreign exchange rate 1.1111 euros per dollar. The swap has a 5-year maturity. The US dollar leg pays 3% fixed annually and the euro leg pays 2% fixed annually. At inception, US Corp gives $10 million and receives 9 million euros. Each year, US Corp pays 3% of $10 million, which is $300,000 to EU Corp and receives 2% of 9 million euros, which is 180,000 euros. From EU Corp at maturity, the principals are exchanged back. US Corp gets back $10 million and gives back 9 million euros. To price the swap, we discount each leg using the respective US dollar and euro discount curves. The net present value is the difference between the two legs. If set to 0, the fixed rates 3% and 2% are the market-consistent swap rates for the given cross-currency basis. Explanation: hedging uses derivatives to protect a portfolio against adverse price movements. Below are 3 typical exam-style problems that illustrate how to pick the right instrument. Problem 1. Stock portfolio hedge with options. You own 10,000 shares of Company X currently trading at $50. You fear a short-term decline over the next 3 months but want to stay invested. Solution: buy a 3-month at the money put with strike $50. Premium equals $2 per share. Cost: 10,000 times $2 equals $20,000. Payoff: if X falls to $40, the put payoff equals $50 minus $40 times 10,000, which equals $100,000. Net position equals $100,000 minus $20,000 equals $80,000 plus the $40 times 10,000 equals $400,000 value of the shares. Total $480,000, which is the same as if the stock had stayed at $50, original $500,000, less the $20,000 premium. The put caps downside while preserving upside. Problem 2. Commodity price risk with futures. A coffee roaster needs 5,000 pounds of Arabica coffee in 6 months. Current spot price equals $1.2 per pound. Futures price for delivery in 6 months equals $1.25 per pound. Solution: go long 5,000 pound coffee futures. Outcome: if coffee price in 6 months rises to $1.4, the roaster gains 1.4 minus $1.25 times 5,000, which equals $750 on the futures, offsetting the higher purchase cost. If price falls to $1.1, the roaster loses 1.25 minus $1.1 times 5,000, which equals $750 but buys cheaper coffee, netting the same effective cost of $1.25 per pound. Problem 3. Interest rate risk with swaps. A firm has a $50 million 5-year loan at LIBOR plus 1%. Management expects rates to rise and wants a fixed rate. Current 5-year swap rate equals 2.5% fixed versus LIBOR. Solution: enter a pay fixed. Receive floating interest rate swap with notional $50 million at 2.5% fixed. Result: net cash flow each period equals LIBOR plus 1% minus LIBOR minus 2.5%, which equals 1% minus 2.5%, negative 1.5% of $50 million, which equals negative $750,000. The firm now pays 2.5% fixed on the swap and receives LIBOR, which cancels the LIBOR part of the loan, leaving an effective fixed cost of 1% plus 2.5% equals 3.5% per year. Explain the difference between a forward and a futures contract. Derive the Black-Scholes D1 and D2 terms and interpret their meaning. Given spot price, interest rate, storage cost, and convenience yield, compute the theoretical futures price. Show how to bootstrap a swap curve from 2-year IRS rates and OIS discounts. Calculate the payoff of a long call, long put, and a vanilla interest rate swap. Common pitfalls. Forgetting to discount future cash flows when valuing swaps or forwards. Mixing up continuous versus annual compounding. Use the same convention throughout a problem. Ignoring the margin impact on futures. The price you compute is the theoretical fair price, but actual cash flows occur daily. Applying the Black-Scholes formula to American options without adjusting for early exercise value. Using the same discount curve for both legs of a cross-currency swap, you need separate curves and a basis spread. Quick recall formulas. Cost of carry futures price. F equals S times e to the power of open parenthesis R plus U minus Y close parenthesis T. Black-Scholes call. C equals S times N of D1 minus K times e to the negative RT times N of D2. D1 equals open bracket ln of open parenthesis S divided by K close parenthesis plus open parenthesis R plus sigma squared over 2 close parenthesis T close bracket divided by sigma square root T. D2 equals D1 minus sigma square root T. Put call parity, C plus K times e to the negative RT equals P plus S. Swap fixed leg present value. PV fixed equals N times sigma alpha I times K times dF of Ti. Swap floating leg present value. PV float equals N times open parenthesis 1 minus dF of T N close parenthesis. FRA payoff. Payoff equals N times open parenthesis R market minus RF R a close parenthesis times delta times dF of settlement. Currency swap net present value. PV equals N sub USD times sigma alpha I times K sub USD times dF sub USD of TI minus N sub EUR times sigma alpha I times K sub EUR times dF sub EUR of TI. Memorize these relationships. Watch the sign conventions pay versus receive, and always check the time units years versus months. With these tools, you can tackle any derivative question in the MBA exam.